Meta, the big tech giant started by Mark Zuckerberg, which owns Facebook, Instagram, WhatsApp, and much more, has seen its stock decline 21% from its all-time high. In fact, it's dropped 17% in just the past couple weeks. Michael Burry, the infamous 2008 Big Short investor, just released a post calling out Meta stocks specifically and the broader AI bubble. He said that we may be in the middle of, quote, one of the more common frauds of the modern era, adding that by 2028, Oracle will overstate earnings by 26.9%, Meta by 20.8%, etc. But it gets worse. So what is he on about this time? Well, he's calling out the extension of depreciation for a lot of these big tech companies who are investing in AI data center infrastructure. As you can see, these companies have gone from 3 years of useful life to 6 in the past 5 years. And he says that by his estimates, they will understate depreciation by $176 billion in 2026 to 2028. So is Michael Burry wrong? Today, I'll share where I agree with Michael Burry around the AI bubble. Then I'll provide a full picture look into Meta stock. Importantly, I'll also share where I disagree and add some additional context. But mainly, I'll provide a full picture look at Meta stock and whether or not this sell-off presents a buying opportunity. Many members of our community have been buying Meta stock recently in this sell-off, and it is one of the highest quality big tech companies in the world. So with that said, let's start this Meta stock analysis. But first, I'll roll the intro.
The following reflects the opinions of a man who spends far too much time thinking about stocks. Please do your own research before making any investment decisions. Nothing in this video is personal financial advice. Continue at your own risk.
My name is Zach. This is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Today, I'll be analyzing Meta stock and giving you my full picture thoughts around the business and the potential AI bubble. Throughout, I will be using the best stock research tool, which is available at dividenddata.com. This is an all-in-one platform designed to help you find better investments. Right now is the best time to join because we just started our Black Friday sale. You can get 50% off annual membership to dividenddata.com, and there's a 30-day money-back guarantee, so no risk in trying it out. This is the best price we ever offer, so jump on it right now if you're interested. The link is in the description and pinned comment of the video. So first, let's start with Michael Burry and the AI bubble. Now, when he's talking about depreciation, inflating earnings, he's mainly talking about net income and GAAP accounting. However, if you've been following the channel a long time, you know I've been sounding the alarm bells that net income can sometimes be misleading. As an example, if we head over to the AI analyst on dividenddata.com, we can see that net income with GAAP accounting really isn't an exact measure of the actual earnings of the business. As an example, depreciation. Depreciation is mainly used for accounting purposes, and it's a non-cash expense. And the benefit of it is that it helps you reduce your taxable income, and it helps create an incentive in our tax system for businesses to reinvest. What Michael Burry is mentioning here with the extension of years of depreciation, it basically would make each individual year less. So they would actually be taking less depreciation each individual year. This is a thing that knocks against their GAAP net income and earnings per share. So Michael Burry is saying that by spreading the depreciation out longer, it's inflating their GAAP earnings per share. However, as a little bit of foreshadowing about my opinion around this, I'm going to highlight this part right here where it says, without affecting cash flow. We are talking about some niche accounting things here. And I saw a funny quote tweet in response to Michael Burry. I couldn't find it right now, but it was basically saying, oh, if only there was other verified financial metrics that we know to look at that don't include depreciation. And we're going to talk about that. And to finish up my point about GAAP accounting, another big thing that I've talked about a lot on the channel is that it takes into account investment gains and losses. That can include private companies that they acquired or public stocks, bonds, and other securities. And the important thing to emphasize here is that this is not realized gains and losses. This is unrealized gains and losses. It's just based on the on-paper value of the assets. So again, this is a non-cash expense, That actually doesn't represent the earning power of the business at that specific time. Gains during a period will increase their GAAP net income or GAAP earnings per share, while losses will decrease the GAAP EPS. And that's why when we look at a company like Berkshire Hathaway as an example, they own a big portfolio of public equities. And you can see if we look at net income, that is highly variable depending on the quarter and depending on the year. But that's not a real measurement of the actual earnings power of a company like Berkshire Hathaway. As an example, if we look at a thing like adjusted earnings per share, you can see that it was continually growing during that period. And that's a non-GAAP measurement, which takes out a lot of those things that I just discussed. This is a problem I have historically discussed with companies like the Altria Group, ticker symbol MO. They had depressed net income for a number of years because they were writing down the value of their failed Juul investment. And that was tens of billions of dollars they had to write down. But those were on paper. That was not reflective of the actual earning power of the business, the actual cash flow it's generating. This made it look like Altria's dividend payment, as an example, was deeply unsustainable in 2020, 2021, and even 2022. But one of my favorite financial metrics to look at, free cash flow, which is the operating cash flow of the business, how much money it generates, minus the capital expenditures they're outputting every year. That is the free cash flow, the amount of money left over to investors that they could use to pay dividends, repurchase shares, invest in future acquisitions, or pay off debt. The free cash flow of Altria Group in that time stayed flat and even continued to grow. And that's why on dividenddata.com for payout ratio, I had this whole section with a free cash flow based payout ratio. And you can see during that time it was 77%, 78%, 81%, which for a high yield dividend focused company like Altria that's sustainable, payout ratio normally on most websites defaults to be based on GAAP accounting, GAAP earnings per share, GAAP net income. And sometimes that really doesn't tell the full picture. It's kind of bullshit. Well, let me rephrase that. It's not bullshit, but you have to understand what it is and what makes it up. So going back to Meta and Michael Burry's depreciation AI bubble, what we are talking about here is slight changes to net income. And is this worth talking about? To an extent, yes. In the same way, a company like Altria or Berkshire at times were underreporting their earnings via net income. Some of these AI companies, Oracle or Meta as an example, which are spending massively on data center infrastructure, may be slightly overstating their earnings based on net income and earnings per share. But if only we had other commonly reported metrics that most people, including me, use to value their stocks. Oh wait, we do. We'll get to that. And that will be a part of my full picture look at Meta stock. And I'll talk about the actual risks I see. And by the way, to poke again at Michael Burry's post here, we had one reply that kind of brought up a little bit of a good point. And that is that the extension of the depreciation years might actually just make sense. There's a huge bottleneck in AI chip production, and these companies are continually trying to expand and add more capacity. And today, these companies are still using NVIDIA A100 units from 2020 for inference tasks. So given the fact we are supply constrained and the life of these assets probably is going to last a lot longer in terms of some usefulness, wouldn't that make sense to extend it? It's a fair question to ask. So what really is going on with Meta stock? Why is it down 18% over the past 3 months? I'm going to dive into it. But before I get into the main risk that I see with investing in Meta stock, which is somewhat related to Michael Burry's and the AI bubble, but kind of different, not on the depreciation angle, I'm going to give you a full picture look at Meta stock and show you the real earning power of the business. So here we can see their adjusted earnings per share, which is using non-GAAP accounting. And you can see it has had a long-term trend towards growth. And in the recent quarter hit $7.25 in adjusted earnings per share. That is a 20.2% increase year over year. And you can see how much their earnings has grown since 2022. That's when we had the end of the zero interest rate era. And we had a weak ad market, the start of a recession, high inflation. That's also when a lot of these big tech companies started to get more fit and cut a lot of the fat they added in the past decade of low interest rates. And they really started to juice their earnings power. And spoiler alert, these big tech giants like Meta, they're some of the best businesses in the history of the world. Not just right now, the entire history of business. As an example, we can take a look at revenue per share for Meta. This has grown at a 10-year compound annual growth rate of 30%. That's insane. The 3-year CAGR is 15.72%. And in the most recent year, they increased revenue per share by 23%. Meta is a highly scalable business, has a lot of things going for it, like its network effects, massive user base, and high usage. And the main business by far is their family of apps. That's Facebook, Instagram, and WhatsApp. And the way that they monetize this primarily, overwhelmingly, is through advertising. Aside from Google with Google Search, Meta is the top digital advertising company. And this thing is a money printer. The company has 81% gross margins, 42% operating margins, and 37% net margins. Free cash flow per share for Meta has grown at a 31% 10-year compound annual growth rate. The 3-year CAGR is 15.37%. And last year, in a year where they were increasing CapEx massively, they increased free cash flow per share by 25%. This company has a large amount of shareholder equity, around $194 billion. So their assets far exceed their liabilities. Now, with all the AI spending, they are ramping up their spending as well. So their cash position's not growing as fast as it could be. They currently have $44.4 billion in cash and short-term investments. The short-term investments are likely in treasury bills, and the company currently has negative $15.6 billion in net debt. Meta has also started slowly repurchasing shares in recent years. That's another way they're giving back to shareholders. And they also started paying a dividend payment as well. And I think long-term, this will be a dividend growth stock for the future. This is similar to Google. It's similar to Salesforce. They just started paying their dividend. And they each had their first dividend increase. This one was 5%. That's matching what Google's first increase was. And these are still very small dividends. They're under a 10% payout ratio. And it really just flexes the earning power of these businesses. The fact that they can pay out these dividends while still investing tens of billions of dollars a quarter into AI infrastructure, it's really impressive. There's only a few companies in the world that can do that. Historically, Meta has gotten pretty good returns on their investments in capital expenditures. Their return on capital employed is 28% as of 2024, and the return on invested capital was 24.8% as of 2024. So what's the big risk going on with investing in Meta stock? Where does this AI bubble potentially come into play? As with capital expenditures. And when it comes to Meta, it's a similar but slightly different problem we've had when I discuss things like Microsoft or Google. Yes, CapEx is ramping up significantly. As you can see in the latest quarter, they reported $18.8 billion of CapEx just that quarter. And that was up from $8.2 billion in the same quarter last year. That's more than a 100% increase year over year. And it doesn't seem like it's slowing down. Over the trailing 12 months, Meta now has $62.7 billion of CapEx. And you can see it ramping right up. Again, more than doubling in the span of a year. And for the full year 2025, they gave CapEx guidance of $70 billion to $72 billion. And in 2026, they didn't give exact numbers, but they're expecting significantly larger, quote, significant growth in CapEx and expenses. And this is where we get to the potential risk around investing in Meta stock. Are they potentially just throwing money away? Will they get a high return on investment for this spending? Mark Zuckerberg and Meta are going all in on artificial intelligence, and they are joining the race. They have reportedly been spending billions of dollars on talent acquisition. Yes, talent. They're paying employees that much money. And they have put together a super intelligence team, and they are planning on being a big player in this space, as you can see from the CapEx. If you don't believe me, they are building a data center the size of Manhattan. Yes, Manhattan. And a couple months ago at the White House with Trump, Mark Zuckerberg said that Meta over the next 3 years is planning to spend $600 billion. Now, I don't know if that's all CapEx or if it's expenses or if it was just a rough estimate or if it's how NVIDIA reports their spending where it includes all of their partners like TSMC. But this is truly a crazy amount of money. For some context, over the trailing 12 months, Meta's cash from operations, so how much money they are generating before capital expenditures, that is $107.5 billion. And it is growing at a high rate, but it's going to have to keep growing or else this CapEx is going to be eating up a lot of their cash flow. And what that would mean as a shareholder of Meta is that that money is not coming to you. It's not being paid to you in dividends or share repurchases. It's not building up a fortress cash position that they use to make acquisitions. It's being put into infrastructure, data centers, and it's unknown how they will monetize that outside of their core business of digital advertising. To my knowledge, since putting together their new superintelligence team, they haven't even released a frontier model yet to compete with OpenAI, XAI, Anthropic, Google, etc. And as of right now, this moment, we don't necessarily know entirely what their AI strategy is. We know that they're going to integrate it into their products, which have very high distribution. Facebook and Instagram, they're massive. WhatsApp is massive. These are some of the largest platforms in the world. So Meta has the distribution advantage. And guys, I'm telling you, I would not bet against Mark Zuckerberg in any sense of the word. But this is a lot of spend they're going to have to get a return on. Now, the bright side is that one of the main use cases for AI and Meta internally is that they use it to enhance their advertising business via ad matching, creating ad copy. There's so many different deep learning techniques you can use that really juice that ad business. And they are just getting started there. So they have a ton of work to do with that. And this is one of the advantages for Meta to compete in this AI race. Similar to Google, they have the money printer. And AI kind of only helps their money printer get better. These ad businesses get better. The products with high distribution, whether it's Google search or Facebook, Instagram, and WhatsApp, they get better because of AI. The usage goes up. Look at this. Meta across all their platforms has 3.5 billion daily active users. That's like just under half the planet. But there's a key thing that's different about Meta to the other big tech companies. And that's that they're not a cloud business. They use their data center infrastructure internally. Google, they have Google Cloud. That's a fast growing business. It's to third parties and they're supporting the whole ecosystem on top of supporting their own business. So it starts to make more sense to rationalize the AI spending. Same with Microsoft. They have Microsoft Azure. They're a cloud business. They get to monetize it through the whole ecosystem of everyone else creating stuff with AI. Right now, Meta doesn't have a third-party cloud business. And to my knowledge, they don't really have an API that they're monetizing, which is how XAI and Anthropic are making money in enterprises. So my intuition is that Meta goes and they start competing, at least in the AI-specific API business. And they go after Anthropic. They try and do the whole XAI battle plan. That's what I think is happening. They're coming for OpenAI. They're coming for Anthropic. It's going to be Mark Zuckerberg's version of XAI, but it will be within Meta. So I'll tell you one thing, it's going to be a very interesting next few years. And I personally don't own any Meta stock, but I would view this 18% sell-off over the past 3 months as a potential opportunity to start building your position. We're in a period of high spending and unknowns right now, which is why I think Meta's selling off a little bit. But long term, I think this business is going to keep growing. Analysts are expecting earnings per share to grow at a high rate in the coming years, double-digit earnings per share growth, double-digit revenue growth. The current consensus price target among Wall Street analysts for Meta stock is $882. That implies that's 41% undervalued at the current price. So if Meta stock stays low or keeps falling, I might start building a position. I've had this on my watch list. If you want to use the stock research tool I'm showing throughout the video, it's all available at dividenddata.com. The link is in the description and pinned comment. We just started our Black Friday sale, which is the best time to join. You can get 50% off annual membership and lock in that discount for life. The link is in the description and pinned comment. There is a 30-day money-back guarantee, so no risk in trying it out. If you like the tools I was showing throughout the video and you're like, man, I wish I had that. That looks really cool. Please try it out. Right now is the best deal we are ever going to offer. And if you join right now, you will get early access to a secret project that I've been building, and I've been teasing it over the past few months. It's not ready to release yet, but if you join right now, you will be the first to get early access when that becomes available. So again, the Black Friday sale, 50% off annual membership, link in the description and pinned comment. Thank you for watching. Leave a like and subscribe to the channel if you enjoyed the video. I'll see you in the next one.